In 2013, China held $1.317 trillion in U.S. Treasury bonds at its peak. In March 2026, that number is $652.3 billion, exactly half the peak. China's Treasury holdings, which topped $1.3 trillion in 2013, had fallen to $693.3 billion by February 2026 and slid further to $652.3 billion the following month. Federal Reserve half of its peak position, gone. Over 13 years of deliberate, documented reduction. China reduced its holdings to $652.3 billion, down roughly 6% from February, the lowest level since September 2008, according to U.S. Treasury data. S&P Dow Jones indices 6% in 1 month, 18-year low. Official data, confirmed and verified. You are watching Finance Expert Pro. Subscribe right now. This analysis is critical viewing. Drop a comment. Did you know China has withdrawn $650 billion over 13 years? Stay until the end, because the gold replacement strategy reveals the full picture completely. The PBOC extended its gold buying streak to its 17th consecutive month, adding 5 tons in March alone to reach approximately 2,313 tons. Gold now accounts for roughly 9% of China's foreign exchange reserves. Business standard. 17. Consecutive months, every month replacing dollars with gold, systematically. China's gold reserves reached 2,308 tons after 15 straight months of central bank buying. China now accounts for 7.3% of total foreign-held U.S. treasuries, the lowest recorded since 2001. The Canadian Vanguard lowest share since 2001. Gold at record levels. The simultaneous trade is fully confirmed. Every dollar withdrawn from U.S. treasuries is being partially replaced with gold reserves. This is not portfolio management. This is a deliberate, decade-long strategic repositioning. Reports from early 2026 indicated Chinese regulators urged banks to limit or scale back exposure to U.S. treasuries, citing concentration risk and market volatility. The data shows a clear downward trajectory through 2025, with the overall pattern of divestment unmistakable. Business standard. Chinese regulators urging banks to limit treasury exposure, not market volatility, policy direction. That instruction from Chinese regulators is the most important data point in this story. It means the withdrawal is not passive. It is actively directed from Beijing's policymakers. In March 2026 alone, overall foreign holdings of U.S. treasuries fell by $138.4 billion, with 7 of the top 10 foreign holders, including Japan, China, Belgium, Canada, and France, trimming their exposure simultaneously. Federal Reserve 7 of the top 10, all trimming simultaneously in the same single month of March 2026. That coordinated multi-country withdrawal is the most alarming March TIC data dimension. Not one country reducing, 7 of the top 10 reducing at the same time together. Now the Section 301 dimension, and this is where the danger becomes genuinely alarming. On March 11, 2026, the U.S. Trade Representative initiated investigations under Section 301 of the Trade Act of 1974 into structural excess capacity or production in certain manufacturing sectors of China and 15 other economies. Affirmative determinations would allow President Trump to impose tariffs and other trade restrictions on imports. Business Standard Section 301, the same legal mechanism that triggered the entire 2018 trade war. The same tool that produced $370 billion in tariffs, now reloaded and aimed at China again. In February 2026, the International Trade Commission opened an investigation to examine the impact of a revocation of China's permanent normal trade relations status on the U.S. economy. That same month, the ITC opened an investigation into PRC state support and pricing practices in biotechnology. The EDGE Malaysia PNTR revocation investigation, biotechnology probe, Section 301 targeting excess capacity, 3 simultaneous legal mechanisms targeting China's economic relationship with America, 3 probes, all firing simultaneously, all creating political pressure for Beijing to respond. Rehook, $652 billion at its 18-year low, gold at 17-month buying streak, 3 probes launched. Now the shadow holdings dimension, the piece that changes the entire official picture. Analysts have long contended official figures undercount China's true footprint in U.S. debt markets. Custodial centers like Belgium and Luxembourg are widely seen as conduits for Chinese sovereign wealth and state-linked investment. Belgium held $454.0 billion of U.S. government debt in March. S&P Dow Jones indices. Belgium, with a GDP of roughly $600 billion, holds $454 billion in U.S. treasuries. That number defies any rational explanation except one. It is not purely Belgian institutional money. Tianqin Xu, senior economist at the Economist Intelligence Unit, said, "If shadow holdings are included, their aggregate figure appeared relatively steady. suggesting China's overall holding of U.S. Treasuries is staying largely stable for the time being, with short-term market volatility being the key factor driving a decline in near-term holding. S&P Dow Jones indices. Relatively steady when shadow holdings are included. The honest picture from EIU analysis. The official $652 billion is the visible portion. Belgium and Luxembourg hold the invisible portion. Becky Liu, managing director of global research at Standard Chartered, said, China's overall holding of USTs is staying largely stable for the time being, with short-term market volatility being the key factor driving a decline in near-term holding. S&P Dow Jones indices. Standard Chartered's managing director of global research, calling it largely stable overall, not a catastrophic, weaponized dump, but a deliberate, confirmed multi-year structural reduction. The distinction matters. Stable total exposure, but declining direct, visible official holdings. The visible reduction signals intent. The shadow stability provides operational cover for now. And intent, combined with 3 simultaneous Section 301 probes and a gold buying streak of 17 consecutive months, is the most consequential financial signal Washington is receiving. Brad Setzer, senior fellow at the Council on Foreign Relations, estimated that China selling its entire Treasury portfolio would generate about 6% of U.S. GDP in sales, which could raise long-term interest rates by about 30 basis points. Bloomberg. Selling the entire remaining $652 billion would add 30 basis points to U.S. long-term yields. 30 basis points means higher mortgage rates, higher auto loans, higher national debt costs, and the 3 simultaneous U.S. trade probes just gave Beijing the political justification to do it. And part 2 is where finance expert Pro breaks down Brad Setzer's full analysis, what Beijing's actual response options are, why the gold replacement strategy is more dangerous than the bond selling, and what every American investor must do right now before the Section 301 investigations reach their conclusions. Part 1 established the raw data, confirmed, official, alarming. China withdrew from $1.3 trillion peak to $652.3 billion in March 2026. 17 consecutive months of gold buying, 3 simultaneous Section 301 probes launched. 7 of the top 10 foreign holders cut simultaneously in the same month. Now, Brad Setzer, the most authoritative voice on this exact topic. According to Brad Setzer, a former U.S. Treasury official currently with the Council on Foreign Relations, if China completely liquidated its portfolio, long-term interest rates would jump by roughly 30 basis points. Investing.com, 30 basis points. From complete liquidation of the remaining $652 billion position. Brad Setzer, senior fellow at the Council on Foreign Relations, said China can sell treasuries and buy lower-yielding European or Japanese debt. Selling the entire Treasury portfolio would generate about 6% of U.S. GDP in sales. Techie AR, 6% of U.S. GDP in Treasury sales from one country's complete withdrawal. The U.S. fiscal model depends on a continuous supply of willing buyers. Washington runs persistent deficits to fund the military, Social Security, federal salaries, and overseas commitments through perpetual debt issuance. When a creditor of China's scale steps back, the arithmetic is punishing. Investing.com. Punishing arithmetic. That is how a former U.S. Treasury Deputy Assistant Secretary describes it. Higher yields, steeper rollover costs, a softer dollar from reduced foreign demand. Economist Peter Schiff was characteristically direct after China advised its banks to reduce Treasury exposure in February 2026. Soon, foreign governments and many private investors will be selling U.S. Treasuries. The main buyer will be the Fed, creating inflation that will send consumer prices soaring. Investing.com. The Fed becomes the buyer of last resort. That creates inflation. That hits every American consumer. The 10-year U.S. Treasury yield climbed to 4.25% following news of China's February 2026 directive to state banks, reflecting concerns that the world's second-largest economy is permanently cooling its decade-long romance with the greenback. Fair Observer, 4.25% on the 10-year, from one directive. Not full liquidation. One advisory to banks. Imagine the yield impact from actual, accelerated, sustained selling instead of guidance. Now, the stealth sell-off dimension. The February 2026 directive, nobody fully explained. The PBOC and the National Financial Regulatory Administration issued a directive to China's largest state-owned banks, advising a strategic and accelerated reduction in their holdings of U.S. Treasury securities, characterized as a window guidance measure to mitigate concentration risk. It sparked a Sell America sentiment across global trading floors. Fair Observer, window guidance. That is Beijing's regulatory language for informal but binding instructions. China's Big Four state banks received verbal instructions. Verbal but operationally binding. For the U.S. Treasury Department, the challenge is now one of narrative control. as they attempt to reassure investors that private sector demand can fill the multi-billion-dollar void left by Beijing. Fair observer narrative control. That is the U.S. Treasury's actual challenge in 2026, managing perception. Private sector demand filling Beijing's void, the assumption Washington needs to be true. Now the Brad Setzer fake de-dollarization analysis, the most nuanced take available. Brad Setzer recently published China's fake de-dollarization, noting that China's consolidated dollar exposure, including state banks, policy banks, and the China Investment Corporation, may be flat or rising even as direct PBOC formal reserves fall. The dollars are there, simply not where the Kofor tables look. VT markets. The dollars are there, just not where the official data measures them, hidden in plain sight. Setzer noted, Treasury announced it will no longer rely solely on PBOC formal reserves to assess intervention. China is now at risk of being designated a currency manipulator if the state bank pattern continues. That is a major analytical step by Treasury. VT markets, currency manipulator designation risk, Section 301 probes, PNTR revocation investigation. 3, escalating legal and regulatory pressures on China simultaneously from Washington. Rehook is $652 billion, Section 301, stealth directive. $30 basis points from Setzer's model. China cannot match the U.S. by putting tariffs on $250 billion in U.S. exports. The U.S. simply doesn't export that much to China. So China could respond asymmetrically and look toward other levers, imposing new limits on U.S. firms operating in China and taking actions that limit their sales in China. Science direct asymmetric retaliation, limiting U.S. firms in China, restricting American company sales access. Apple, Tesla, Nike, Starbucks, Ford, all significantly dependent on the Chinese consumer market. If Beijing restricts American companies as a Section 301 response, the corporate earnings impact is immediate. Now the honest, complete picture, because Finance Expert Pro always presents full analysis. Tianchen Xu, senior economist at the Economist Intelligence Unit, said China's overall holding of U.S. Treasuries is staying largely stable when shadow holdings through Belgium and Luxembourg are included. Belgium held $454 billion, Luxembourg around $439 billion. Aggregate figures appeared relatively steady. S&P Dow Jones indices. Steady in aggregate. That is the honest constraint on the catastrophic scenario. Shadow holdings in Belgium and Luxembourg add $893 billion to China's visible $652 billion. If those are included, China's total footprint in U.S. debt markets is closer to $1.5 trillion. A country with $1.5 trillion in total U.S. debt exposure cannot fully weaponize it without self-harm. Jeff Klingelhofer, portfolio manager at Thornburg Investment Management, anticipated that if China committed to dumping treasuries, it would have an immediate and temporary impact on money markets. But it would be a bigger hit to the sustainability of what China is trying to accomplish globally. Techi R, bigger hit to China's own objectives. The nuclear option hurts the user, not just the target. That is the structural constraint that has kept China's Treasury withdrawal gradual, not explosive. Now, 3 things every American watching Finance Expert Pro must do right now. First, watch the Section 301 investigation timeline carefully through the rest of 2026. Affirmative findings allow tariffs, which trigger Chinese asymmetric retaliation options. If Beijing deploys its asymmetric options, American corporate earnings and bond yields both move. Second, understand the gold signal. Gold reserves reached 2,308 tons after 15 straight months of central bank buying. Gold now accounts for roughly 9% of China's foreign exchange reserves, marking a clear strategic hedge against dollar asset concentration risk. The Canadian Vanguard, 9% of China's reserves now in gold, up from near zero a decade ago. Every ton of gold bought is one more step away from dollar dependency, documented and real. Third, separate the political noise from the financial data every single time. The official $652 billion is the visible withdrawal. The shadow holdings show operational stability. The stealth directive to state banks is the policy signal. The full liquidation is the deterrent. China is not crashing America's bond market. It is reducing its dollar concentration risk methodically. Over 13 years, from $1.3 trillion to $652 billion in a straight line downward. And the Section 301 probe, targeting excess capacity across China's manufacturing sector, is the next escalation that makes that downward line steeper, faster, and more deliberate going forward. The arithmetic is punishing, as Setzer said. Every American carrying debt, every taxpayer funding a $2 trillion annual deficit, every homeowner tracking mortgage rates is downstream of that arithmetic. China's $652 billion is half its peak. The next half depends entirely on what Section 301 delivers. That is the complete breakdown. Share this with every investor who needs to understand what China's 13-year repositioning means for American households in real time. Subscribe to Finance Expert Pro for the financial intelligence that tracks what the official data confirms and what the shadow data reveals. Drop a comment. Do you think China will accelerate its Treasury withdrawal if Section 301 tariffs are imposed? We read every single one. See you in the next one.